Southeast Radio's Business Matters with Karl Fitzpatrick.
I'm now joined by a resident economist, Marc Coleman. Marc, the European Central Bank pushed back against bets of imminent cuts to interest rates on Thursday last by reaffirming that borrowing costs would remain at record highs despite lower inflation expectations. What are your thoughts on that?
So yeah, that's pretty much as expected. And we chatted about this in late September 28th, I think. So the reason the ECB hasn't cut rates, what we said back in September was rate cuts are not going to happen until the second quarter of next year or at the earliest March. And the reason the ECB is not going to cut rates is because its forecasts, as distinct from the inflation rate now, its forecasts don't show inflation hitting its reference value of 2% until 2025. So its outlook is only beginning to suggest that inflation will come back under control, as far as the ECB regards it as being under control, for early 2025. So what we need to see happen before it can credibly start cutting rates is we need to see the forecast for inflation for 2025 go below 2%. And I believe that's going to happen. So the forecasts are done by the ECB twice a year. It was twice a year when I was working there. We've had the winter forecast. I think we're going to get the spring or summer forecast next year. I think that's when, if the current rate of inflation keeps declining at the rate at which it's declining, which is quite rapid, the forecast for inflation for 2025 is going to go from being slightly above 2% to possibly around 1.6%. And that's when the ECB will not only say, okay, we've got inflation under control, but we actually now have to cut rates, because what we don't want is a situation where inflation is too far below 2%. Because if inflation is too far below 2%, that means the economy is at risk of recession and we'll have more job losses than we need to keep inflation under control. So it's a tricky game. It's like driving an old car where the steering isn't very good. That's what monetary policy is all about. The wheels don't necessarily go exactly where you want them to go. But I'm pretty confident now that in Q1 of next year, the forecast, the outlook will show inflation coming under control in the following 18 months. And of course, that's not only where the numbers are going, but that's where the politics are going, Karl. And I've given you my take on this. Let's just say that it's a very, very convenient coincidence for the European political system that a couple of weeks after the most liberal-leaning country probably in the Eurozone, the Netherlands, voted for a far-right party in power, that the establishment in Europe is very, very worried about that spreading. And we've seen polls in Germany showing the far-right Alternative for Deutschland party are now almost in joint lead. They're as popular as the three coalition parties in Germany put together. And we saw this week in France a shock defeat for Macron in the Assembly, the French National Assembly, where compromise legislation on immigration was defeated by the far left and far right coming together. So really, the establishment of Europe is now saying to itself, look, if the numbers are pointing even halfway towards cuts, for goodness sake, cut, because if we don't cut, and this is not the official story is the inflation target, but the unofficial story, I think, is if rates don't start coming down in the next, 6 to 9 months, the political carnage will have people pointing fingers at the ECB and people saying, hang on, you guys didn't just overshoot. You created an inflation figure that was way lower than 2%. Which means you went further than you had to. You created more job losses than was needed. You created more recession that was needed. But look at the political results. You've possibly handed France and Germany over to political chaos, which will have further inflationary consequences, because if you have populist governments, you tend to have populist economic policies, and they tend to be more inflationary than conventional ones. And I'm not getting involved in the politics here. None of my business about how the good people of the Netherlands, France and Germany vote. But from the point of view of monetary stability, at the back of any central banker's minds has to be the principle of do no harm. So if they can find justification in the numbers and the forecasts in the next 6 months to start cutting rates, they will. And I believe they will find that justification as soon as the next round of forecasts come out, which I think is March or April of next year.
Well, if you've just tuned in, that was our resident economist, Marc Coleman. And I'd like to thank Marc for his incisive economic analysis during 2023. And we look forward to Marc joining us again on the programme from the 6th of January. We're almost at closing time here now at Business Matters, but before we go, I'd like to take this opportunity to thank my production team, my guests for their contribution, and especially you as always for listening. Join me again next Saturday morning when we'll have more for the world of business. But until then, have a great week.
Southeast Radio's Business Matters with Karl Fitzpatrick.